Perfect. This is Jason Matthews, your financial guru. Today, I wanted to talk to you guys about one of the biggest, best tax breaks that you could do to transfer wealth. And with that tax break, what we wanted to do is talk about step up in basis. I want to explain to you guys what it is, how you can take advantage of it, and how it can impact you and your family for years, decades, and generations to come. So today, if we bought a house, you say you bought a house back in 1970. And you bought the house for, let's say, $100,000. And you bought the house for $100,000 in the 70s, and today it's valued at $1 million. And the day before you sell the house, the day before you die, you decide to sell the house, which is now we are paying taxes, and you sell it, and now we made $900,000 in profit, where we sold it to our kids the day before we have it. That $900,000 of profit that we made, we're going to have to pay capital gains taxes. And the current capital gains is 20%. Which means now on 20% of that $900,000, our tax bill is $180,000 because we sold our property. $180,000 because we sold that property the day before we died to our kids. Now, a great strategy we could use is what we call a step up in basis, which means instead of selling our property to our kids the day before we pass away, we keep the property in our family. And let's look at the impact of that. Let's say that same house, and instead of selling it to our kids, we keep it into the family. And that property, we actually bought it for $100,000 and back in 1970, but today my kid's going to inherit it and it's worth $1 million. Instead of them paying taxes on that $180,000 as they receive it because I just passed away, the tax bill for them is going to be $0. Huge tax benefits, $0 on that $1 million. It's one of the biggest tax breaks we have to transfer wealth. It's what we call the step up in basis. But let's say your kids decide to have that house and they sell it 20 years later. And now say that $1 million, the property is, now it's worth $2 million 20 years later. And so now they only have to pay taxes on the growth of it. So they made an additional $1 million since you passed away on the home. They pay 20% tax, and now they pay $200,000 on a house they got for free. This what you call is the step up in basis and one of the biggest tax breaks. Now, one big issue I'm seeing a lot of people do is they make joint tenants or joint owners of the property to their kids, thinking that is an easy way for them to transfer the house to their kids. Instead of doing that, whenever you have a house, and it don't even have to be a house, it could be stocks, it could be bonds, it could be any other investments that are not in your retirement accounts, could all take advantage of step up in basis. The key though is we do not transfer and have joint tenant, but we make it as we're the sole owner till the day we die and then we pass it on. Also, with our stocks and bonds, based on the financial institution we have, they know what we have, what they call the date of death. Date of death is what is the value of the property the day that I died. Now with real estate, what you have to do, and I highly recommend, is you get your property appraised at the value based off of death. Now I see a lot of people when they receive this property or inherited, they wait time forever to get appraised, and the appraisal is not as accurate as it possibly could be. But if we get appraised as soon as our family member, our mother, our dad, our grandparent dies, we can have an accurate number what our step up in basis is. Also, any upgrades we did to the house are deductible. So the paint that you put on, the lawn care, any type of work you did, the real estate agent for the sale of the house, is all deductible to subtract from the capital gains. So today, I just want to talk to you guys about the biggest tax hole to pass down property, which is a step up in basis. Remember, this is Jason Matthews, your financial guru. Give us a call if you have any other questions, 510-229-7608.